So what is working capital? The first and foremost question is, this is the fund which is required by every business to run its daily operations or to fulfill its financial needs. If I have to give a simple statement, if a company has certain financial needs on routine basis, on daily basis, they have, every company, every business may have certain financial needs to carry on its operations, to run its business, right? So to the fund which is required to fulfill those financial needs to carry on the operations of the business or company very smoothly is working capital. Working capital has a formula, that is current assets minus current liability. So I would say working capital is net current assets or excess of current assets over current liability. Let's say if I have started a business just very recently and my business current assets are 1 lakh, that is I have only cash, no receivables, no inventory, nothing. Okay, it's the day 1 Jan 1st. Okay, and my current liability is 0, nothing. I have not given any, I've not bought the goods on credit basis, just it's a start. So what is my working capital? 100,000. This is the one which I will be using to run my operations smoothly, or I will be fulfilling all my financial needs, whatever I have on daily basis. If I have a financial need of 10,000, I can use this money 100,000 to fulfill this need of 10,000 as of today, right? So this is the concept of working capital. Small example, a company has long-term goal and short-term goal. To fulfill long-term goal, it requires long-term capital. To fulfill short-term goals, it requires short-term capital. Short-term capital is working capital, or the capital which is utilized for working or fulfilling the financial needs of the business or to run the operations of the business smoothly is working capital. I have already given the example. Let's say your father wants you to become a graduate and he wants to enroll you in a college. So he goes to a college, inquires, and he pays 3 lakh rupees for the 3 years fees. Comes home and tells you that I have paid the fees of the college, and my dream or my vision or my requirement or my long-term goal is that you should become a graduate in 3 years. I have fulfilled that, for fulfilling that goal, I have made this payment, or I have a requirement of 3 lakhs to make the payments in the future. So this is long-term capital to fulfill long-term goals or long-term needs. But this is not enough to this is not enough for you to pursue your education. To pursue your education or to attend the lectures in the college, you have to go to college on daily basis. For that, you require every day you require some money, right? So your father has to give you 200 rupees on daily basis for you to go to college. You know, auto rickshaws, rapido, whatever services you take, and some buffer funds you should have. Sometimes you may be hungry in canteen or whatever. So every day he should give you 200 rupees. If he doesn't give this 200 rupees for your to and fro journey from your home to college and college to home, you cannot pursue your education. So this is very simple. This is what it is, the short term capital or working capital which a person requires on daily basis to fulfill their financial needs of going to college, right? In the same way, businesses may have certain daily expenses. They have to buy some inventory, they have to pay some expenses to labor for loading, unloading, they have to deliver the goods, they have to pay delivery charges. There are n number of expenses which they'll meet with this fund. Now comes the cash conversion cycle. See, if I'm not wrong, have we discussed this cash conversion cycle in ratios? Please tell me. Yes or no? Hello.
Yes, sir.
We have covered this cash conversion cycle in ratios, right? Yes. Yes. So the formula for cash conversion cycle is stock conversion period plus debt collection period minus debt payment period. That means you bought inventory and it is taking for you to convert that inventory into cash like 100 days. It is taking 100 days for you to convert the inventory into cash. you may sell it in on you may sell your inventory on cash basis, or you may sell your inventory on credit basis, but almost all it takes 100 days for you to convert your inventory into cash, and then it takes 70 days for your credit sales to get converted into cash. The people to whom you have sold the goods on credit basis, some goods you may sell on cash basis, some goods you may sell on credit basis, so it takes 70 days, and all in all 50 days you are taking to make the payment to your suppliers. So all in all 120 days is your cash conversion cycle. This is the time period whereby you converted your inventory into cash, you tried your level best to convert your credit sales into cash sales, okay, and also you made the payment to your suppliers. So for 120 days the cash was in circulation, or this cycle was going on. What was the cycle going on actually? You wanted inventory for manufacturing, okay, you wanted inventory for manufacturing, and then you bought that inventory from the payables, okay, that is purchase, and then like these raw materials have been converted or manufactured, and like you have the finished inventory or finished goods, then you started selling them, okay. See, raw material comes through purchases, and then it is converted into finished goods through manufacturing, and then you have the finished inventory, okay, and then you want to sell it. You may sell the goods on credit basis, then you'll collect cash, and then you'll make the payment to the payables, okay. So everything is going on in a cycle. First, purchase of raw metal from payables, you bought the raw metal from payables, you started manufacturing, and you are having finished goods, the goods are manufactured, you are selling it to customers, okay. You're taking some time to collect your money from your customers, okay. The cash has come to you, and then this cash you made the payment to your suppliers, and all in all 120 days you took, or it took, for all this to happen, right? That is what we have calculated. Now certain points we'll discuss. The calculation of the days inventory in hand, or stock conversion period, or uh, like uh, in the sense debt collection period or debt payment period is covered in our financial statements reading on financial analysis techniques. All are already discussed. Now you want a higher cash conversion cycle or lower cash conversion cycle? Of course, lower cash conversion cycle. The lower the cash conversion cycle, the lesser time we are taking to convert our inventory or receivables into cash, and we are making the payment to our suppliers, right? So a lower CCC is generally better, as it indicates that company can generate cash quickly and efficiently, meaning that less of the company's capital is devoted to working capital. That means you don't have some stuck funds, or you are using very less amount as working capital, because maximum times you are trying your level best to close in, or reduce the cash conversion cycle, so that you may you may have more cash in circulation, right? So so a lower CCC is generally better, as it indicates that a company can generate cash quickly and efficiently, meaning that less of the company's capital is devoted to working capital. That means you take less loans, you take less overdrafts. A high CCC may indicate that company is taking longer to convert its investments into cash, which could lead to cash flow problems and potentially limit the company's ability to invest in growth opportunities. Of course, if you're not getting cash on time, then how will you flourish? Okay, and then again you have to take loans, again the burden will increase on you. So a company can decrease its cash conversion cycle by decreasing its inventories and receivables, by increasing or extending its payables. So how you can decrease your cash conversion cycle? Let's say decreasing its inventories and receivables by increasing or extending payable. However, each of these has potential disadvantages. So what happens? Reduced inventory of raw metal may create production bottlenecks. That means you may have, if you decrease, see what is happening. If your current assets is more and current liability is less, you have a higher cash conversion cycle. If your current assets are less and current liabilities, not current assets, I mean to say, see DCP, debt stock conversion period. Let's say in our example only, if this is my like cash conversion cycle, let's say this has become 50 and this has become 30 minus 50. Now what is your cash conversion cycle? 30 days. Is it right? So if I have reduced this, if I am converting the inventory into cash very sooner, if I'm converting my receivables very sooner, okay, and I'm extending my days to make the payment to my suppliers, that is better for my business. See, extend like collecting our money very soon and delaying the payment to suppliers is good, you know. Now you'll ask me a question, sir, why it is so, why we should delay the payment to suppliers? See, delay in the sense, not like out of the like you should not cross your limits in that case. Okay, you should not cross your limits, but reduction of these two is definitely reducing my cash conversion cycle. So what are the disadvantages? Reduced inventory of raw material may create production bottleneck. That means you have less inventory, so you may face shortage. You may produce less, and the customers and there'll be a shortage of stock in your company, and the customers, you know, they will be upset and they may look for other sellers, right? Because you don't have adequate inventory. So reduced inventory of raw metal may create production bottlenecks due to supply chain disruptions. Okay, so if you like if the inventories are reduced and then you may have some bottlenecks. Bottleneck is nothing but some kind of constraint. Okay, some kind of deficiency due to supply chain disruptions. Reduce inventory if supply chain disruption is there, then what? So like reduced inventories of finished goods may mean an inability to meet spikes in customer demand. Of course, you're not able to, you may have stockouts, you are not able to meet your customers demand. But second thing, if you reduce or you tighten the credit to customers, you may lose sales. Why? Because your customers want more flexibility to make the payments to you. So you're trying your level best to reduce your stock conversion period. Okay, by taking less inventory, by taking less inventories. Okay, and but that may create hurdles or bottleneck resources or constraints or inability to meet the customer's demand. And if you tighten the credit, then what would happen is the customers, there'll be lost sales, right? Because if you are tightening the credit for your customers, then what, you know, like customers want greater flexibility for making the payments, and if you like kind of don't give them enough credit period, or if you tighten the credit terms, or you have some strict terms with your customers, then you lose sales, right? So we can think of accounts payable as an implicit source of credit from suppliers. Yes, see, you don't have money, so you can ask that for you can ask your suppliers to grant you credit, or they are the ones who are making the payment for you and getting the goods to you or supplies to you. So suppliers offer payment terms in the form A by B net C. So just give me 5 minutes of time. I'll be back. Okay, give me 5 minutes of time.